My name is Andrew Stotson. I want to welcome you to the Valuation Master Class Show. And today, I'm going to talk about gold. And gold's gone up quite a bit. And I'm going to try to help all of us think about gold. One of the things that's interesting about gold is that for many, many, many years, gold was not a performing asset. If you had asked me about gold in an equity portfolio 10 years ago, there's no way I would have said you should have it in a portfolio because it never performed in the long run better than equity. But the world is broken. And the levels of debt in the US, the levels of debt in China, the levels of geopolitical conflict and the like has caused gold to go through the roof. So what I want to do is talk a little bit about gold and how we should think about gold. And if, by the way, you want to get this presentation, just send me a message at Andrew Stotz and just type in gold and I'll know what presentation to send you. I think you'll find this interesting today. So let's get started. I'm going to go to the first presentation. And actually, before I get to that, I just want to talk briefly about what we're trying to say here. And let me do that 1 second. So measuring the world in terms of gold is what I want to think about a bit. Today, I want to talk about what we'll call real value, not prices in dollars, but what things are truly worth compared to each other. And to do that, I want you to picture something very specific. Unfortunately, I don't have one to hold in my hand, but I want you to picture an ounce of gold. It's a very small, heavy bar. It's about the size of a credit card standing on its edge, but 3 cards thick. So think about that bar, roughly like that. That's an ounce of gold. And that little bar is going to be our measuring stick. In fact, it just fits in the palm of your hand. Now, the reason that I use gold is simple. It doesn't change. Think of it like a ruler. The ruler stays the same. That piece of gold, that ounce of gold, 50 years ago is the same ounce of gold today. It's just that the value of it has gone up and down over time. So we're going to measure things against that item. So what can this ounce of gold buy? That's really the first question that we need to think about. And that question I'm going to think about, and I'm going to talk about this over and over, right? So what changes, as I say, is everything that we measure against gold. So I'm going to ask this question over and over again, which is, what can this 1 ounce of gold buy? Now we're going to look at 3 things. Energy, which is measured in barrels of oil, and work, which is measured in days of pay, and a home, measured as how much a typical home this 1 ounce could cover. And we're going to use the US because we have the best data there, but also we're trying to understand gold in relation to the dollar. Now, we're not talking about trading gold for a house, right? That is about relative value. If 1 ounce covers only a small part of a home, then housing is expensive in gold terms. Now, if it covers more, then gold is holding more purchasing power. Now, before we start, let's have a bit of context. I was born in 1965 when the dollar was tied to gold. Very different than today when the dollar is no longer tied to gold. Actually, it hasn't been tied to gold for a very, very long time. But when I was 6 years old, in August of 1971, the US ended the gold standard. President Nixon famously got on camera and ended the gold standard. And from that point on, money, particularly the US dollar, floated. And from that point on, we needed a different way to measure real value. When the dollar was fixed to gold, then we had the dollar tethered to something that was real value. But once the connection was broken and gold went out of the scene, then the dollar could go up and down depending on how people felt about the quality of the dollar. And if the government printed more dollars, value of the dollar would go down. So let's anchor ourselves just before that break, right? So in 1960, let's go back from 1971 when the dollar was broken from the system. And in 1960, one second, let me just, yeah, before I'm going to continue, but I got a really interesting question from Mohit. What do you think of yield curve control? I think yield curve control is going to happen in the United States. And that is an excellent question. And I'll talk about it at another time because there's a lot to discuss there. But yield curve control basically is to say the market, and let's think, Mohit, about yield curve control. When we think about that, we're thinking about really the long end of the market. Let's think 10-year government bonds. If the market is saying that 10-year government bonds are trading at a yield, let's say, of 5%, that's the market price. So, and the Fed can't really control that long-term price. They can control the short-term price a bit, but it's not like they can buy and sell the long-term bonds that easily. But, you know, let's imagine that they could for a minute. And they said, we want yield to go down, right? Then we need a bigger supply, right? So if yield's going to go down, that means that bond prices are going to go up. So they're going to have to take bonds out of the market. And they can't do that really at the long end. And so what they're just going to do is make a rule or a law or a guideline and say the US government only pays 2% for 10-year and beyond money. If you're going to borrow from us, it has to be 2%. So the market will say, wait a minute, the market rate is 5%. Why would I, lend money to the US government at 2%? Well, the answer to that is there are many entities in the US that have to own and are regulated by the US government to own long-term government bonds. And basically, the US government can force them to own bonds at this yield curve controlled yield. And the reason I'm thinking that's going to happen is related to the extreme amount of debt and all of that, which is another topic. But Mohit, that is an excellent question. All right, so let's continue on, right? What I was saying is that I want to go back to 1960, and gold was fixed at $35 an ounce. And that 1 ounce bought about 12 barrels of oil. Energy was cheap. Now, I've made a table to help you visualize that. And let's look at that table right now. In that table, you're going to see that I'm going to show dollar gold price and the dollar oil price at the top of this table. That's going to help us kind of understand where things are at. And then we're going to look at what 1 ounce of gold buys in oil, in wages, and in home. Those are the three measures we're going to look at, but I also included the stock market as a reference. So the S&P 500 units per ounce of gold is what we're talking about. So now let's forward into 1960. So here we are in 1960, and gold was fixed at about 35, roughly, ounces, right? So $35 per ounce. And also oil price was about $3 per barrel. Energy was super cheap, right? And basically what we can see is that that gold bought 12 barrels of oil from 1 ounce of gold. And we can see that it bought 3 days of average wages of the average worker. And for housing, 1 ounce covered roughly 0.3% of a typical home. So a very small amount of the home price. Homes are expensive compared to a little ounce of gold. And that means we would have needed 340 ounces of gold to be able to get to the full price of a home. And then finally, we can see that stocks in this period of time, it would take 1 ounce of gold would buy 0.6 units of S&P 500. So what we can see that money, energy, wages, and housing were in balance. And you'll see that more as we go through. Let's now move to 1971. So I'm going to go forward and I'm going to add 71 in here. And with 71, we're going to see the gold average about $41 an ounce. And we can also see that oil was at 3, the same. So this bought about the same number of barrels, about 11 barrels, and energy was still abundant, tons of energy. And it bought roughly 2 days of wages, and housing became more expensive in gold terms, right? 1 ounce covered about 0.2% of a home. And now it took about 600 ounces to match the full price. And ultimately, we can see the stock market, 1 ounce of gold bought 0.4 S&P units. So the anchor had been removed, even if the effects were not yet obvious. It took time once Nixon brought us off the gold standard. So next, I want to go to 1980, which was my, first year in high school. And this was the peak of inflation and the oil crisis that we had at that time. And I remember as a kid sitting in line with my parents waiting to get oil from the petrol station. So here we have 1980. And what do we see? The first thing we see is gold average about $613 an ounce. And that 1 ounce bought about 16 barrels of oil. And energy stress was intense. Oil price had gone up 10x in just a short amount of time. And I'm looking at 1980. Before 1980, in the 70s, it had already gone up. So the stress was very high. So 1 ounce bought about 18. So you can see also, not only did oil price go up, but gold price went up more than 10x. And 1 ounce of gold bought about 18 days of wages. And housing flipped dramatically. 1 ounce now covered about 1% of a home. And it took just over 100 ounces to match the full price of a home. Homes weren't that expensive at that time. And gold had gone up, as you can see, from 41 to 613. Gold mattered because confidence in paper money was breaking down. Now, also just to highlight that here we can see that gold could buy 5 units of the S&P, which is pretty incredibly showing how valuable gold was relative to the S&P. So that is 1980. Now I want to jump to 2000, after a couple of years, a couple of decades of having the dollar broken away from gold. And let's look at it. This is the height of the dot-com boom, right? This is when the stock market was extremely high. So gold averaged about $297 an ounce. It was out of favor. Nobody cared about gold. They were all investing in the stock market. And that ounce bought only about 9 barrels of oil. And energy was becoming more expensive and relative expensive. Now, it bought about 3 days of wages, which is very small. And housing stretched. Again, 1 ounce covered only about 0.2% of a home, and it took more than 600 ounces to match the price. And most importantly, because it was a huge boom in the stock market, what we can see is that 1 ounce of gold only was able to buy 0.2 units of the S&P. This was peak confidence in paper wealth. Then came 2008, the global financial crisis. At that time, gold really, oil really shot up. So let's look at that. And what we're going to see in that period of time is that Gold averaged about $872 an ounce. And that ounce, and you can see also that oil was at 94. And that ounce still bought about 9 barrels of oil. So energy stress had not gone away. Now, remember that oil price in 2007 was very high. It went up to about 150, as I recall, or 130. And now it had come back down by the time we looked at 2008 because the economy was starting to collapse. So I didn't pick the peak of the oil price, which would have been about 130. So also 1 ounce of gold, that 1 ounce in our hand, bought about 8 days of wages. And housing was near a bubble peak. 1 ounce covered about 0.4% of a home, and it took roughly 266 ounces of gold to match the full price of a home. So financial excess ran into some physical limits. So now we've gone through the history. Let's move forward to the next period, which is 2000. This was COVID time. And we can see that was the pandemic, of course, and gold averaged about $1,773 an ounce. And oil was at 37. During COVID, everybody thought there's no more demand for oil. And so oil prices were collapsing. Imagine that those oil prices went back to the levels that they were in 1980. Incredible. That 1 ounce of gold bought about 45 barrels of oil because, as you see, gold price went up massively. It went more than doubled. Or about doubled, let's say, and oil price went down by 2/3. So energy demand collapsed. And gold, that 1 ounce of gold in your hand, bought about 12 days of wages. And housing shifted again. 1 ounce covered about 0.5% of a home. And it took roughly 190 ounces to match the full price. Policy and stimulus dominated everything. And finally, let's go to today. Where are we at today? This is where it gets really interesting. And I've built up, at this point, I've built up this table to try to help us kind of lay the groundwork of where things have been over time so that we can put where gold is and oil is in context. And I think you're going to find this interesting. So let's now go into, one second. All right. So now we're going to go into 2026, where we are right now, today. Look at gold. Just incredible. Gold is trading around $4,500 an ounce. And that same 1 ounce, you can see oil's gone up a bit to 59, but it's not like super high. That 1 ounce buys about 78 barrels of oil. Incredible. Energy is not the bottleneck now. Oil and energy is everyone. And it buys about 22 days of average wages because, again, gold prices have gone up massively. And housing really stands out. 1 ounce now covers a little over 1% of a typical home. In other words, because gold price has gone up so much, it takes roughly 90 ounces, in other words, 90 of these 1 ounce, ingots to match the full price. So what does this all tell us? And also, by the way, for those people that think that the US stock market is in a bubble, you can argue that it's not in a bubble. In relative to oil price, it's not in a bubble. So what does this all tell us? Well, when 1 ounce of gold buys very little energy, the world is constrained by physical limits. Energy matters most. And when 1 ounce of gold buys a lot of energy right now, the stress is in the monetary system, not in the physical oil or physical asset system. Debt, confidence, and government policy matter much more. Now remember, that ounce of gold never changed in this whole analysis, but oil, wages, and homes did. They moved based on what society valued or feared or pushed too far. So the next time that you hear about high gas prices or oil prices, rising wages, or unaffordable housing, pause for a moment and picture that small, heavy metal bar of silver or gold in your hand and ask one simple question. And that is, what can this little bar buy now? That question will cut through all the noise. So this is my discussion on what's been happening with gold and what's happening with oil. These are two critical things. One has to do with the physical production of oil, and one has to do with the value of the monetary system. And one of the things about gold is that gold ultimately is a store of energy that's been used to extract it from the earth. Let's look at some questions and then we'll wrap up. So hold on. Yep. Okay. Sarah Paul says, if interest rates stop declining or remain high, gold as well as stocks face a big downside risk this year, isn't it? Well, I think, one of the things that's interesting about the table that I just showed you was the fact that maybe the U.S. Stock market is not as expensive as it feels. Now, I do think that what you're going to see is that if the large tech companies start to come down, okay, that's going to be a problem for sure, and that's going to bring down the whole market. But so let's just look at what you're saying. If interest rates stop declining, okay, if interest rates stay high, or let's just say if interest rates stay high, it's just more pressure on the economy. But it's not really pressure on companies so much, because they're not the problem. They're not over leveraged. It's the government and the Fed that suffers the most, the US government, the Treasury, that suffers the most from these higher interest rates. So I wouldn't necessarily say that it's going to have a huge impact on the profitability of companies, but I do think that it can affect the multiples that we're using. Now, gold as well as stocks face a big downside risk this year. Well, I think, gold has run up quite a bit. But why is gold running up? I think gold is running up for some very specific reasons, and that is a concern of people about the US dollar. And there's many different ways that the US government can handle this. And one of the big ways that they can handle the problem of too much debt is basically not pay it back, and instead do some calculations that will give them more money that they can use to pay people back. And that's another topic I'll talk about. But yes, there's definitely risks. Let's look at another question from Deborah. All right. Does that mean gold and dollar prices have a positive relationship? No, generally what's happening is that the dollar, when gold goes up, it's indicating that the dollar is weak or troublesome, right? That's the way you want to look at it. All right. Well, that wraps up my discussion about gold today. I think it's a fascinating one of what's going on, and I've been working on this over the last few days. So today was my first kind of presentation of it.